I'm David Cowen. Welcome to the Museum of American Finance. For the first time visitors, we hope during the reception you'll take in and look around this magnificent museum or come back during our regular hours when we're open to the public. We are the only public museum that is representing the financial world and the capital markets in the United States. We're a 501c3 organization. We're a Smithsonian affiliate, and to learn more about us, www.moaf.org. Now, we've got a really exciting program tonight, and I want to thank our lead sponsor, Protiviti. Protiviti has been a great friend of the museums and also has a representative on our board. I also want to thank KX Systems, a new friend of the museum, and they are our reception sponsor tonight. I also want to thank that this evening program reflects the active participation of the Bateman Group and then our longtime supporters and very close friends at the New York Stock Exchange. Now we have our chairman of the board with us tonight. His name is Professor Richard Silla. We also have board members in attendance tonight, Greg Bauer and Adam Goldstein. Now, if you were to create a finance museum in the United States, you would put it in New York City, you would put it on Wall Street, and that is us. And we are very fortunate that we get to see all the exciting IPO activity that's happening right up the street at the stock exchange. There's also a vast amount of private equity and venture capital money out there, and Telis Demos writes about all of that for the Wall Street Journal, and he will have an initial conversation with a man who is at the center of the IPO market, and that is Tom Farley, the president of the New York Stock Exchange, as we discuss tonight our topic, a behind-the-scenes look at public versus private funding, addressing that age-old question of going public. I'm not going to get into long bios tonight. On your chairs, you found a piece of paper with everyone's bio. I will welcome, though, the panelists. We have David Klein, the CEO and co-founder of Common Bond, with us, a very interesting private company in the student loan marketplace. Howard Katzenberg, the CFO of On Deck. We thank you for coming out. You'll see he's on crutches tonight. A relatively recent IPO is On Deck, involved in online business lending. Sean Magnani is the Senior Managing Director at Guggenheim Securities, and Howard Morgan, partner and co-founder of First Round Capital. There's going to be a brief Q&A for the panel. You have 3x5 cards. We ask that you write your questions on the cards, and then midway through the panel, we'll come through and collect those. Now, I'm going to turn the program over now to Steve Hobbs. Steve is the Managing Director of Protiviti's public company transformation practice based in California. He's going to give you an overview and a layout and thematic for tonight's discussion, themes for tonight's discussion, and then I'll be back at the end to welcome you to the reception. Steve?
Thank you, David, and thanks to the museum for hosting this great event. We appreciate it. I'm the warm-up band tonight. One of my objectives is to put a Halloween hex on the Kansas City Royals. I'm not sure how I'll be able to do that, but I'll certainly try. But to also maybe set the stage for the fireside chat and the panel that distinguished panelists tonight that are going to share some thoughts about the capital markets. I thought by way of introduction, as I think about my experience over the last 30-plus years in the capital markets, there's really been some changes in the last 5 to 10 years. And so I got just a few stats that I'll share that I think maybe exemplify what's changed. Number one, as of the end of September of 2015, there were 115 unicorns, which is a privately backed company that had valuations greater than $1 billion. That's double what it was a year ago, and certainly more significant than it was 5 or 10 years ago. The average age of a company going public in today's environment is 11 years. If you go back maybe 10 years ago, or when we had the dot-com bomb, the average age was 5 years. And then we did have the Jobs Act that was put into place in 2012 to stimulate some activity. And then I think the last thing that's probably a big change is the rise of the third-party pre-IPO secondary markets. All of these things have caused, I believe, the public markets to change. Maybe there's not the sense of urgency that there might have been before. Or you're worried about alternative types of financing. I was leading a conference an investor conference in San Francisco a few weeks ago, and we had the CFO of a company that it was in the travel industry, and it had gone public, and then it had just been taken private because it was acquired. And I had him on the panel, and the purpose of the panel was to talk about how great the public markets are and what a great thing it is to do an IPO. And so in his opening remarks, he said, being the CFO of a public company sucks. So I thought, who invited this guy to be on the panel? Really not for everyone. And so some of these developments probably do the following. They maybe provide a little more time for a company to thoughtfully think about what kind of an exit they want, what kind of investors they want to join at the hip with. And also not necessarily be in a rush to go public just to go public. Perhaps there's other things that can be done in the organization, fundraising activities that can be done that will meet the needs of the company. So with that additional time, I think that's great for a lot of companies, because at Protiviti, we work with companies. We worked with 1 out of every 4 IPOs in the last couple of years. And I could say almost to a company, their ability to be prepared to be a public company, and we've got a CFO of a company that's recently gone out, it's a big lift for companies. Most of these companies, we were involved with a couple of large social media moguls in the West, and some of these companies were thinking about going public in as soon as 5 years. I mean, who would have? That's a long lead time. But many of these companies had no infrastructure. Most of the money for at least younger, smaller companies goes into product development, protection of your intellectual property, sales and marketing, and nobody has a lot of appetite, particularly at the board level, for spending a lot of money around infrastructure so that you can scale and compliance requirements that come with being a public company. So I think the changes in these markets actually are good for companies, because it provides many more options than what existed previously for companies to think about. They don't feel like they have to have a gun at their head, that they have to get out into the public markets. Now, having said that, I still believe that the public markets are a very attractive way to obtain liquidity, get great valuations, but you really need to go into it with your eyes open, because we live in a world and in a country, if you're regulated by the SEC and the other regulators, there's a certain amount of risk that comes with being a public company. So with that, I'm going to turn it over to our panelists, or at least to our fireside chat, and to Tom and to Tellus, and hopefully this will be a good event for you. We're grateful that we could be sponsoring this event tonight. Thank you.